Hello, friends. Welcome to today's edition of BFF, Brief Finance Funda, brought to you by Ethical Advisors. Today, we bring to you our thoughts on where Indian stock markets are placed versus US markets and other peers. A quick snapshot, as you can see, Indian markets over the last 12 to 18 months have heavily underperformed the major peers, including overseas European markets, US markets, including NASDAQ, and also its Asian counterparts like Japan, Korea, and Taiwan. Investor feedback from my recent overseas trip is extremely negative, and rightly so, because mutual funds and equity shares held by non-resident Indians and domestic residents have yielded very, very poor and also negative returns. To cap it all, the Indian rupee has also crossed 95 to the dollar, not really adding to the comfort of non-resident Indians. Let's understand why India has underperformed so badly. Remember, India was the darling of the world markets till 2024 mid or end year, and then suddenly the rest of the global markets started catching up. Take a look at NASDAQ, which is the US tech heavy index. Look at the Dow Jones, which is again American index, and then look at the FTSE, German, French, and other Asian indices. You can see very clearly that this underperformance has happened. If we actually go to the depth of this underperformance, one thing very clearly stands out. The US markets are actually propped up by the tech heavy NASDAQ index. But when you look at NASDAQ, which consists of more than 3,300 stocks, only 10 stocks have contributed to more than 70% of the rally in the last 1 year. Because these tech heavy stocks have risen, they now account for almost 45% of the NASDAQ total market capitalization of $45 trillion. Its younger brothers are in the form of similar stocks in Korea, Taiwan, and Japan. If you look at these companies which feed into the AI boom, the rally in these Asian markets is justified. So TSMC, for example, Taiwan Semiconductors, and many other stocks which are indirectly or directly linked to the AI mania and the expansion of these 10 stocks, which are largely AI driven stocks on the NASDAQ, which we spoke about. Obviously, their siblings have also risen, and their weightages of these tech stocks is very heavy in these Asian indices. So does it mean that India is done and dusted? Should we dump India? Should we not do anything here? The answer is exactly the opposite. Ethical Advisors today is pounding the table and asking all domestic and foreign investors to start increasing their equity allocation. This is a major change of view. In the last 1.5 years, we've been extremely guarded. But with the markets coming down and having also on a global level underperformed its peers, we are very comfortable in recommending that investors slowly start getting back. So clearly, with the rupee also at all-time lows, for non-resident Indians, there couldn't be a better chance to bring their money in. Another argument which we found on the latest trip was that if I'm getting 4% in or 5% in US dollar deposits, why would I bother to have a negative return in India? Friends, contrarian view always helps. Big money is made when investments are planned, when you swim against the tide and you take a more mature and educated view. So Ethical Advisors, again, to sum up the argument today, Indian stock markets have corrected, global markets have outperformed, and that phase is over. Remember, markets always move in cycles. Nothing stays up or down forever. So with all our conviction, we are asking investors to increase their equity allocation to India. For new investors, we are asking them to stagger the investments from now to Diwali. And trust me, you will make money if you're a long-term investor. If you flirt with the market, you will not make money. Have a very profitable day.